Okay, let's dive into this, because today, in this explainer, we are looking at the most powerful financial institution that almost nobody ever talks about. Seriously, if you walk down any street right now and asked 100 people what this company does, I guarantee 99 of them wouldn't have a clue. Yet, if they just disappeared tomorrow, the entire global financial system would literally stop. It's wild. We're unpacking the extraordinary and honestly at times shocking 234-year rise of State Street Corporation.
$49 trillion. Yeah, trillion with a T. That is State Street's assets under custody and administration as of 2026. To put that completely mind-boggling figure into perspective, it actually exceeds the combined gross domestic product of the United States and China. They are quietly holding and safeguarding the retirement savings of hundreds of millions of people all around the world.
And their influence doesn't stop at custody. State Street, alongside BlackRock and Vanguard, the guys often called the Big Three, they collectively sit as the largest shareholder in 88% of all S&P 500 companies. 88%. They don't just hold the world's wealth, they possess this unprecedented, concentrated power that actually shapes the global economy.
Section 1. America's most boring bank.
Let's move to and see how this builds. To figure out how they acquired this Leviathan level of power, we kind of have to travel all the way back to the very birth of the United States financial system. This modern colossus actually started as a really modest local bank. Back in 1792, a dying John Hancock signed the charter for what was then called Union Bank in Boston. Over the decades, while their rivals were collapsing during currency freezes, credit panics, and the Civil War, this bank just kept surviving. Fast forward to the early 20th century, under the leadership of a guy named Alan Forbes. Now, Forbes ran a deeply conservative, no-nonsense shop. While other institutions were gambling wildly during the Roaring '20s, Forbes held the line. Because of that extreme discipline, even through the catastrophic 1929 stock market crash and the Great Depression, the bank never missed a single semi-annual dividend. Basically, they survived by being incredibly boring.
And you know what? That boring reputation perfectly positioned them for a brand new service: custody. As the Gilded Age created massive industrial fortunes, and later, as the very first mutual funds were invented in Boston in 1924, these massive pools of wealth needed a sophisticated guardian. You couldn't just hand your money to a fund manager and cross your fingers, right? You needed an independent institution to act as a vault with a brain, someone to physically hold the securities, settle the trades, and keep all the books. Custody became State Street's quiet superpower.
Section 2. The Information Processing Factory.
So State Street rode this post-war wave pretty nicely, but deep down, they were still fundamentally just a regional New England bank. Well, that'll change in the late 1960s. When a booming stock market actually triggered a complete systemic catastrophe, it was known as the 1967 paperwork crisis. The manual trading system on Wall Street entirely collapsed under its own weight. I mean, think about it. Every single stock trade required physical pieces of paper to be hand-matched by armies of clerks just drowning in basement back offices. As trading volumes surged past 10 million shares a day, the system broke. Over 100 brokerage firms failed, not because they made bad investments, but simply because they couldn't process their own paperwork. Billions of dollars were lost in the chaos. Wall Street desperately needed technology.
And this brilliantly illustrates the ultimate turning point for State Street. In 1975, they brought in a new CEO named William Edgerly. Now, he wasn't a traditional banker. He was an engineer from manufacturing who had studied IBM. He looked at that paperwork crisis and sought a massive technology market just waiting to be captured. So he radically pivoted this 183-year-old institution. He shut down retail branches, froze commercial lending, and went out and hired over 100 executives straight from IBM. He essentially transformed State Street from a traditional bank into a massive, automated information processing factory running on IBM mainframes.
Edgerly's pivot was visionary, for sure, but his timing was absolute perfection. Just as he was building this technological machine, Congress passed the massive 1974 ERISA Pension Reform Act. This created enormous new compliance and reporting needs for corporate pensions all over the country. State Street had the software ready to go. By capturing this market, they delivered investors an absolutely staggering total return of 33% per year throughout the entire 1980s. 33%.
Section 3. Birth of the ETF.
By the early 1990s, a new, battle-tested CEO named Marshall Carter took over to push this machine global. But to really dominate, they needed a revolutionary product. That vision came from a 74-year-old physicist named Nathan Most. He imagined a product that works sort of like a warehouse receipt. You'd deposit a basket of securities and receive a tradable receipt that could be bought and sold all day long on an exchange. He called them Standard & Poor's Depository Receipts, or SPDRs. He actually took this idea to Jack Bogle, the legendary father of index investing. But incredibly, Bogle rejected it outright. He just flat out said it wouldn't work. The dramatic irony here is incredible. The father of index investing said no to what would eventually become the single most important innovation in the history of the field, the Exchange Traded Fund, or ETF.
But Nathan Most refused to quit, and on January 29, 1993, the SPY ETF officially launched. Behind the scenes, though, it was hanging by a thread. To make it work on day one, State Street had to audit 500 individual securities, which is normally a 45-day process, in just 16 hours overnight. A 27-year-old State Street manager named Jim Ross literally built the primitive operational plumbing using punch cards just to prevent the entire thing from dying on its very first day. That frantic overnight effort gave birth to a literal financial leviathan. Today, SPY is the most heavily traded security on planet Earth. It trades an average of $55 billion daily and holds nearly $700 billion in assets.
Section 4. A culture of betrayal.
By this point, State Street had become a global colossus. But, incredible growth can sometimes mask deep systemic rot. When the 2008 financial crisis hit, State Street survived, but the extreme turbulence shook loose some incredibly dark secrets, specifically how they were actively betraying the clients who trusted them the most. So the crucial point is that from 1998 to 2009, State Street ran an elegantly simple yet devastating scheme on foreign currency transactions. Clients, like major pension funds, allowed State Street to automatically handle foreign exchange trades, fully trusting them to get the best market rates. Instead, State Street applied predetermined hidden markups to those trades. The clients saw an inflated price, and State Street quietly pocketed the difference. When whistleblowers finally exposed this, State Street agreed to pay penalties and client reimbursements totaling over $530 million. $530 million! It's absolutely vital to understand this. This wasn't just one rogue trader making a mistake. This was a deliberate, systematic, institutional policy. For 11 years, stealing from the retirement funds of teachers and firefighters wasn't a glitch. It was literally their business model.
Now, what's really interesting about this quote is the sheer, chilling casualness of the culture that had developed. As the company was reeling from the foreign exchange scandal, another fraud was already happening right under their noses in their transition management division. This actual exchange was read in a federal courtroom. State Street executive Ross McClellan asking his colleague, "How much do you want to take?" And the response? "Whatever, let's see how we go." Just two executives casually deciding over small talk to steal millions of dollars.
And here is exactly how they did it. When large sovereign wealth funds or pension plans restructured their massive portfolios, McClellan's team would add a hidden 1 basis point commission to the trades. Now, that's a microscopic percentage, but it silently siphoned off millions of dollars from these massive transactions. Then, they directly ordered the deletion of any evidence of those commissions from the trading results that were sent to the clients. They stole from the retirement fund of British postal workers and the Irish National Pension Reserve. When he got caught, McClellan initially tried to pass it off as fat finger typing errors. Yeah, right. He ultimately became the only State Street executive to serve time, receiving an 18-month federal prison sentence.
Section 5. The $49 trillion reckoning.
Despite billions in fines and some brutal executive layoffs in the years that followed, State Street didn't die. Actually, fueled by the explosive trillion-dollar growth of the ETF industry they helped create, their balance sheet just grew larger. But holding this much power brings an entirely new kind of scrutiny, which brings us to a massive modern legal reckoning. In December 2024, the Attorney General of Texas, alongside 10 other states, filed a major lawsuit against the Big Three: BlackRock, Vanguard, and State Street. The lawsuit basically accuses these financial giants of acting as a cartel to manipulate energy markets. The core allegation is that they acquired substantial shares in U.S. coal producers and then weaponized that concentrated voting power to pressure those companies to produce less coal, aligning with green energy or ESG goals. The case has been escalating quickly. While Vanguard broke ranks and agreed to a $29.5 million settlement and withdrew from climate groups, State Street has strictly denied the claims, calling the entire lawsuit baseless.
The trial is completely ongoing, but it presents a really profound question for us to think about. When a few massive financial entities collectively own a massive chunk of an entire industry and jointly push for specific corporate behaviors, is that simply responsible environmental stewardship on behalf of modern investors, Or does it cross the line into illegal cartel behavior? That is exactly the complex legal and ethical debate that federal courts are attempting to unravel right now.
And it all stems from the sheer scale of what this company has become. Over 234 years of history, State Street has transformed from a tiny local bank, signed into existence by a dying revolutionary governor, into an invisible financial leviathan holding $49 trillion in assets. It is a staggering story of intense discipline, visionary technological reinvention, and, as we've seen, shocking betrayal.
Which leaves us with this final thought. When a single institution that you've likely never even heard of holds more wealth than the GDP of global superpowers, when they quietly process the trades, safeguard the assets, and hold the voting shares that steer the biggest corporations on Earth, it really forces us to ask, who actually controls the global economy? Is it the visible politicians and CEOs we see on the news every single day, or is it the invisible financial custodians operating quietly in the background? Keep that in mind the next time you check your retirement account. Thanks for joining me on this explainer. I'll see you in the next one.